Obedience and subordination are concepts that shape not only personal behavior but also the global financial world. They influence how institutions work, how markets respond, how investors behave, and how economic power is structured. In every company, in every market, and in every leadership hierarchy, there are layers of authority and layers of responsibility. These layers form a system in which obedience functions as the engine that keeps the financial machine running, while subordination forms the order that protects stability. To understand obedience in finance, one must first look at how money moves within society. Money is not only a tool for buying and selling. It is an agreement built upon trust. This trust is maintained through rules, laws, and structures set by authorities. People obey these rules because without obedience the entire financial structure would collapse. Subordination is necessary in this structure because every large-scale financial system operates with a chain of command. From central banks to commercial banks, from companies to small businesses, each entity is connected through layers of authority. Consider a central bank. Its decisions are guidelines for the entire economy. Interest rates, inflation targets, reserve requirements, and currency regulations determine how money circulates. Financial institutions must obey these policies because the stability of the national economy depends on coordinated behavior. If banks refused obedience, if financial institutions ignored the guidelines, the markets would fall into chaos. Trust would be lost, credit would freeze, and uncertainty would spread. This shows how obedience and subordination create harmony in the financial structure. In corporations, the same dynamic exists. Companies are built upon hierarchy. Boards of directors, executives, managers, and employees form a chain of authority. Every level has a role in maintaining financial discipline. Subordination ensures that instructions flow smoothly from the top, while obedience ensures that these instructions are carried out consistently. Without this structure, no company could remain stable, especially in a competitive global economy. Imagine a multinational corporation that handles billions of dollars. It operates in many countries, interacts with multiple markets, follows complex regulations, and faces constant competition. For such a company, subordination is essential. Each department, finance, human resources, marketing, logistics, product development, and compliance, must work under a clear chain of responsibility. If every team acted independently without obedience to the central strategy, the corporation would lose its competitive advantage. Production would slow, marketing would misalign, costs would rise, and overall financial health would suffer. Obedience does not mean blind acceptance. In finance, obedience is rational, purposeful, and strategic. People obey rules because they understand that rules protect stability. For example, investors follow risk management guidelines. These guidelines exist to prevent losses and maintain long-term financial health. When an investor respects diversification principles or follows stop-loss rules, they are practicing obedience to financial wisdom. This obedience preserves their wealth and supports market stability. Subordination also appears in international finance. Nations interact with global financial institutions such as the International Monetary Fund, the World Bank, and regional financial authorities. These institutions set conditions for loans, create regulatory frameworks, and offer guidance for economic policy. Nations that seek financial support must follow these conditions. This form of subordination is part of global financial cooperation. It protects both the lending institutions and the borrowing countries by ensuring financial discipline. On the personal level, obedience and subordination influence financial success. Financial discipline is a form of obedience. An individual who follows a budget, who respects savings plans, who pays debts on time, and who follows long-term investment strategies practices obedience to their own financial goals. Subordination at the personal level means placing long-term goals above short-term desires. It means allowing reason to dominate emotion and placing structure above impulse. In this way, subordination becomes an inner hierarchy in which logic leads and desires follow. Businesses also rely on subordination to manage financial risk. When economic conditions change, leaders must adjust strategies. They may cut spending, reorganize departments, or shift investments. Employees must follow these decisions for the company to remain stable. This obedience is not weakness. It is strategic unity. A company in crisis cannot survive without coordinated action. There is also ethical obedience in finance, which prevents corruption, fraud, and exploitation. Ethical standards protect investors, consumers, and the public. Obeying these standards builds trust, while breaking them destroys institutions. History is full of financial scandals that emerged when individuals refused obedience to ethical rules. These scandals caused enormous damage. In contrast, institutions that follow strong ethical obedience build reputation, trust, and longevity. Subordination in markets appears through price movements. Markets have natural laws. They respond to supply and demand. Investors must obey these laws. No individual can fight market reality. When demand falls, prices fall. When supply rises, value may decline. Investors who refuse to acknowledge these rules often suffer losses. Those who subordinate their strategies to market conditions survive and thrive. In financial trading, obedience is crucial. Traders must follow algorithms, signals, strategies, and risk limits. Subordination protects them from emotional decisions that lead to disaster. Patience, discipline, and timing all depend on obedience to structured systems. A trader who ignores rules becomes unpredictable. A trader who obeys rules becomes consistent and profitable over time. In economic theory, subordination forms the hierarchy of needs in financial planning. Emergency savings come before luxury spending. Stable investments come before speculative ventures. Long-term planning comes before short-term indulgence. Individuals who follow this order create stability in their lives. Those who ignore it often fall into debt, stress, and financial insecurity. In leadership, obedience and subordination shape organizational culture. Leaders must set clear expectations and employees must follow them. However, leaders also practice obedience by respecting laws, regulations, and stakeholder responsibilities. Even the highest executives are subordinate to the financial realities of the business. They must obey the limits of cash flow, market demand, and economic cycles. The financial world is also full of examples where obedience becomes innovation. When teams follow structured processes, they free mental space for creativity. Order creates clarity, and clarity creates opportunity. Subordination does not suppress innovation. It organizes it. It gives it direction. On a societal level, obedience to financial structures ensures prosperity. Citizens pay taxes, obey financial laws, and participate in regulated markets. This creates public revenue, infrastructure, growth, and stability. Without this obedience, society would face disorder. The economy would become unpredictable and development would slow. Even technology in finance depends on obedience. Automated systems follow strict rules. Algorithms execute trades only when conditions are met. Artificial intelligence models obey mathematical structures. Every digital tool is built on subordination to logic. Without this obedience, technology would produce chaos instead of efficiency. Global trade is another example. Countries obey trade agreements. Businesses obey customs regulations. Banks obey international settlement systems. This creates a predictable environment that allows goods, money, and information to move freely. Without such obedience, global commerce would collapse. At the philosophical level, obedience and subordination represent acceptance of order. Finance is built on order. Markets need rhythm. Currencies need stability. Companies need structure. Investors need rules. Without these principles, the financial world would have no foundation. However, obedience must be balanced with wisdom. Blind obedience can lead to exploitation. Subordination must be guided by justice and fairness. Financial systems must protect participants, not misuse them. Therefore, ethical oversight, regulation, transparency, and accountability ensure that obedience serves the public good. In leadership, subordination must never be used to suppress truth. Employees should follow instructions, but they should also have the freedom to express concerns. Healthy financial institutions maintain open communication. Obedience without communication leads to failure. Subordination without respect leads to corruption. When leaders listen and followers respect authority, balance emerges. In global finance, obedience to environmental standards is rising. Companies must obey sustainability regulations. Investors now consider environmental, social, and governance factors. This form of obedience supports planetary stability and long-term economic health. It is an example of how subordination evolves with societal values. Financial education teaches individuals to obey principles that protect them. Risk management, budgeting, credit discipline, and long-term planning are forms of obedience that lead to freedom. When a person masters money through disciplined obedience, they gain control of their life. When they ignore these principles, money controls them. Therefore, obedience and subordination are not limitations. They are foundations for growth. They shape the order that allows wealth to be created and preserved. They protect individuals from chaos, protect companies from collapse, and protect societies from instability. In conclusion, obedience and subordination are essential pillars of financial life. They create order, discipline, harmony, and trust. They ensure that markets function, that companies survive, that nations cooperate, and that individuals prosper. When applied wisely with fairness, transparency, and ethics, these principles become instruments of stability and success. They transform finance from a chaotic force into a structured system that supports human progress.